So,
Oh, wow.
yeah.
Well,
Yep.
hey, Nan, I think we are 5 minutes in, so everyone should be just about on that's coming, and we have 16 participants, so that's about how many signed up. So I think we're good to start if you would like to.
Okay,
Um,
great.
we do need to ask you, would you rather us hold questions to the end or chat them as they come up? Kelly will.
Chatting is fine because
Okay.
Kelly will be on there and can handle those or not. And I'll explain what I mean by or not in
Okay,
just a moment. Okay.
perfect. All right, so
Okay.
everybody, I'm going to go ahead and mute us and leave Nan unmuted, and so that way we can really all hear and focus on what she's talking about. So outside of that, Nan, we are recording this, everyone, but I have Nan under the spotlight, so y'all's faces will not be shown, so you don't have to worry about that. And outside of that, I think we'll just mute and she can take off from here. Thanks, Nan.
Okay. Thank you very much. And thank you very much to the library for providing the opportunity for us to present these important programs. And of course, right now, everybody wants to know what's happening with taxes. So we're going to handle that as best we can with what we know. I am the instructor today. I'm also what's considered to be the president of the Bernie chapter of AFIA. I'm going to talk a little bit more about AFIA in just a moment, but what I'm going to do, just so you understand the format of what I'm doing here, is I'm going to go dark so that I'm not using an extraordinary amount of bandwidth and get us in any trouble with reception, and which is also why I'm wearing the headset, which those of you that I Zoom with regularly don't normally see me in this. So we want the best delivery that we can possibly have. And again, we will be giving you an opportunity to schedule a call and so forth, but the chat will be open, so you'll be able to chat, send a message. Kelly will be monitoring those. I will not, because I'll just be focusing on the presentation. But if there are questions that we're able to answer, we will in fact do so. What we want to focus on here is how taxes have changed, and we are going to focus on the Tax Cuts and the Jobs Act of 2017 because those are the provisions that are still effective. We may have some changes coming up with the new administration. We don't know that for sure at this point in time, so we're not going to go too far into that. But what I do want to be sure that you know is that we have a lot of information available, and we will be providing everyone with a 2021 chart of taxes as they stand now. You'll be able to receive that by requesting it via email. You get information on that. But I also want you to know that if things do change, we will update that and make that available to you. There's one more thing I want to mention before I get into this, and that is once you have attended one of our AFIA presentations or any other presentation that we do. We sometimes do presentations for organizations other than AFIA, but once you've attended, we put you on our mailing list so that you are informed whenever we're doing a presentation. It doesn't mean we expect you to attend, but you may want to attend, and you also may want to have someone else in your family, some friend or someone who can benefit. So just want you to know that that's how that works, that you'll always be invited. I want you to keep your questions general in this, if you would, please. And everyone is entitled to have a 20-minute call with me to answer any specific question. It's difficult to address a particular situation in a group setting. And so I want to be sure that you have the opportunity to have a call with me. Also, I think that you'll see on the screen now that to schedule the call, you can click on the link, or you can call our office and schedule that call. So we use a nice calendar system that allows you to book a time when I'm available. And it will actually be me that you talk to. So that's kind of helpful that I will understand where your question is coming from. Okay, so I want to talk a little bit about AFIA. The nonprofit mission of AFIA is to inform and empower Americans to take control of their finances, but by providing comprehensive financial education in communities nationwide. And once again, I want to thank the library because it is primarily through libraries, colleges, and community colleges, universities and community colleges, that we are able to get information out to people. And I can't tell you, especially in this time that we've all been through, how much people seem to appreciate these opportunities to learn. So a little bit more here about AFIA and how we're funded. Okay, so as I said, I'm a chapter president, but we are a collection of people from around the country who work in the field of financial education. We are all, well, I am a financial advisor. Kelly and Tom and I have a company here in Boerne and also an office in Monterey, California. And our focus is on planning for retirement. But this work that we do with AFIA, we do this on a volunteer basis because we understand how important it is. AFIA is funded through personal donations. It's also funded through chapter sponsorships, and that's what we are as a chapter sponsor. There's also tuition in advanced courses, no tuition in this particular situation. And then there are reasons why people want to belong to AFIA. That generally applies to the professional community. But you are able to make a donation if you're so inclined. It mentions here a workbook. We're not using workbooks in this setting, obviously, but you can, in fact, make a donation through myafia.org, which brings me to something that's really important. And I really want to encourage everyone to do this, and that is to become a member of AFIA. Now, I will assure you that nothing is done with this information other than to be used by us, the local chapter, to be sure that your questions are answered. AFIA is 501c3 organization. They do not provide this information to anyone at all. But what you can see if you're looking at the screen is that there are financial calculators. There are also other resources other than the presentations that we do that are available. Information when things have changed in the financial world, especially in tax, there's information that comes to you from AFIA. So you need to register. The only important thing for you to know is that our chapter ID is 4636, and that is important for you to know what the chapter is. So the one thing that I must do, according to the rules of AFIA, is to read the actual disclosure, and I'm required to do this. So AFIA, the American Financial Education Alliance, is recognized by the IRS as a 501c3 nonprofit charitable organization that provides educational workshops and classes in businesses and universities nationwide. Our instructors are licensed and trained financial professionals with a minimum of 5 years in real-world experience in their field. They've been required to pass a series of training sessions on how to properly educate in a not-for-profit setting before becoming a personal financial coach and an instructor in AFIA. AFIA courses and workshops do not promote or endorse any specific products or companies, and no selling is allowed. AFIA educational workshop courses are for general education only and are not intended to be construed as investment, tax, legal, or financial advice. Attendees should seek the assistance of a professional familiar with the course prior to implementing any of the ideas and strategies taught or discussed in the course. Hypothetical we're not going to talk about rates of return at all, but If we were, it would all be hypothetical. Rates of return are not guaranteed or for illustrative purposes only. Projected rates do not, and again, we're not going to talk about that. So I'm actually going to move forward in the disclosure and say the presenter, me, Nan Lesnick, is in no way employed by or affiliated with or endorsed by the IRS, the Social Security Administration, or any other government agency. The presentation is not intended and should not be construed as tax advice. Please consult with an enrolled agent, a CPA, an attorney before implementing any of the strategies discussed herein. All examples are hypothetical and for illustrative purposes only. Actual results will vary. No part of this presentation is intended to make an offer or a sale or a purchase of any specific security or insurance product. So let's move on to the agenda. Let's discuss why we're here today. First of all, we want to understand the legislation that is the subject of today. And then we will also discuss marginal tax rates, interactions between income types, strategies to reduce lifetime taxes, and then what else you should do. Many of you have likely seen Ed Slott. He's on PBS periodically talking. He is recognized as being America's IRA expert. And Ed has a saying that he opens almost every one of his talks with, and I think that it's important. And it's something I want you to keep in mind as we are going through the information today. And that is, not all money is taxed the same way. It's really important that we understand, and even income, not all income is taxed the same way. So we want to keep that in mind as we're moving through here. One other thing I want to mention is that the examples that we look at here are married filing jointly. I know that not everyone on the call is in that situation. Some people are single, but the principles are not different one from the other. We just find it easier to stay with one example than to switch back and forth. So I don't know how you feel about tax reform, but if you're confused, I want to be sure that you understand that you're not alone. We have had some perplexing things happen with taxes, and I think that for the most part, taxes are generally a little bit difficult to understand. In theory, it's pretty straightforward, and it's extremely similar to what we had before, but the changes that were made in 2017 that are effective now changed our brackets, okay? You can see the brackets here that are listed here, and those are the brackets that we are currently using. And we're going to discuss brackets and what they really mean as we go through here. So in 2021, what you'll see is taxable income between $0 and $19,000. The ordinary income bracket is 10% of taxable income. You can follow that down. I'm sure that that's not any mystery to you. I think an important thing for you to keep in mind is when we use the terminology taxable income. Okay, here's a different way of looking at the tax brackets, and this is what we call a tax map. Okay. So it's sometimes a little bit easier to visualize the tax brackets. It is showing what each additional dollar of ordinary income is taxed as you move through the brackets. So notice from 0 to 27,800, there is no tax, and that's due to the new larger standard deduction, plus an additional $1,350 for each taxpayer, if we're talking about a married couple, if both clients are over the age of 65. We're going to discuss that a little bit more further, a few slides further. From about 27,800 to just over 47,700, income falls into the 10% bracket. Okay, and then So what you're seeing here is only the income that falls in that range gets taxed at 10%. I guess I got a little ahead of myself on this slide. Okay, now for income that falls between 47 and 108,000, that's taxed at 12%. Okay, so back here in this example, again, I moved my slides forward a little more quickly than I should have. So if these ranges look odd to you, it's because the standard deduction has lowered the actual tax. There are two spots on this map, though, that are really important to pay attention to. Okay, and that is the big jump from 0 to 10%, and again from 12 to 22%. Okay, what you see there is that and the jump from 24 to 32, where the biggest opportunities for planning lie. Now, what we mean by opportunities for planning, you may have heard the terminology bracket bumping. Okay, so as we are looking at taxable income, and especially as we are looking at deferred income, that would be 403B, 457, 401k. These are all forms of income that you may be planning on for retirement that have been, the tax has been deferred. What we will be talking about to a great extent is how important it is to reduce the amount that will be subject to tax as much as possible. So we've just hit here on a very important concept, and that is the concept of marginal tax rates. Okay. Marginal tax rates are sometimes difficult to understand, especially when we mix in with them capital gains and qualified dividends. So capital gains and qualified dividends get their own tax bracket that are separate from ordinary income. Now, these brackets are lower primarily because of the public policy goal of encouraging investment in the economy. Okay. All public policy, as far as personal finance, the Social Security Administration and the people who are involved at CMS, the Center for Medicare Services, are aware of the fact that we need to incentivize people to invest in their own retirement. There's still a marginal tax concept for capital gains and dividends, but the brackets are considerably different. So a question might be, at what rate are capital gains taxed? Well, let's take a look at that. Okay. If you have taxable income between 0 and 80,800, you have no capital gains responsibility. Capital gains bracket is 0. If your taxable income is between 80,000 and 500,000, plus or minus a few dollars there, your capital gains bracket is 15%. And the capital gains bracket of 20% only applies to taxable income of $501,601 and above. So what you see here is that there is an opportunity, especially for those who have stock and other company stock. For the company that you retired from, you may have stock with that company, or just simply money in brokerage that you're using for income. The capital gains rate, as long as your income is under the 501,600, is at 15%, and that's pretty favorable. So, but let's take a look at this. Although 15% is the rule of thumb, this does not hold true all the time. So here's another tax map that we're looking at. If you only had dividends and capital gains on your return, you would pay 0% until you have enough to fill that 12% ordinary income bracket. less $250 in the year of 2021. For taxpayers in the highest ordinary income bracket, the capital gains rate is 20%. Now, this is an important concept because it shows how capital gains taxation is actually linked to ordinary income. Once the combination of capital gains plus ordinary income pushes you above the threshold, your capital gains rate becomes 15%. You can see that where we've gone from 0 to 15%. This structure didn't really change under the new law, but because of the new target standard deduction, the range at which it impacts you changes. Okay, now let's talk a little bit more. Some of this might not be completely clear, but it will become clear, I hope, as we go through and talk about deductions, exemptions, and credits. Okay. These reduce your net federal tax bill, which effectively makes the first several $1,000s in your household tax-free. Let's talk about deductions. First of all, we now have a standard deduction of $25,100 for a married couple or $12,550 for a single person in the year 2021. In the alternative, you can itemize deductions under Schedule A, mortgage interest rate on debt of up to $750,000 of acquisition debt, not including a HELOC. Now, I know some of the people on this Zoom today are in California, and we have had a limitation on mortgage interest. So if you're in that category, I'm certainly willing to talk to you individually about that. But other people are in Texas and don't have the state income tax situation that you have in California. So I want to address that on an individual basis. So again, mortgage interest, charitable gifts of cash or checks up to 60% of income, state and local property taxes up to $10,000, and an additional deduction for being age 65 or older or blind remains. Okay, so that means that your income is reduced, your taxable income is reduced by the standard deduction or the combinations that we've shown here. There are exemptions for being alive, and that's really all that the exemption related to. Okay, it was a personal exemption for $4,150 per person. That changed and has been eliminated because of the standard deduction being implemented. So it is believed, and I believe this as well, not just experience or knowledge, but experience with clients, that clients are better off with the standard deduction, especially since so many people enter into their retirement years with little or no mortgage remaining. Let's now talk about, I forgot to click that and say that personal exemption is gone because of the exemption is gone because of the personal exemption. Okay, let's now talk about credits. Okay, credits used to be there to incentivize behavior. There was a healthcare tax credit, there was an earned income tax credit, there were education credits, savers credits, child credits. Okay, and most of those still do exist. Okay, two of the most common tax credits are the health tax credit and the earned income credit. The less common one that may be accessed by some people who take a part-time job in retirement, is the savers credit. And this basically incentivizes lower income people to save in retirement accounts even after they have retired from their primary occupations. Remember, even if you've been a high earner all of your life, your tax return may be set up to present you as a low earner between the point of a formal retirement and the time you are forced to begin taking required minimum distribution from IRA accounts. Now, I want to stop here and address the fact that many of our clients have in excess of $1 million, sometimes $2 or $3 million in deferred accounts. Okay, in other words, in 401ks, money that they are continuing to accumulate. They are enjoying returns of the stock market. But it's very important to be focused on the fact that at some point in time, age 72 specifically, you will have to begin taking required minimum distributions. And those required minimum distributions can be very significant. So I want to emphasize again that between the time of retirement and or even before retirement, if you are allowed to make in-service withdrawals from your 401k or other employer plan, it's important that you begin to focus on what the tax will actually be. Okay, so now let's look at some facts here. Okay, an example of a couple with a $38,000 gross income, okay, that is all ordinary income. At least $2,000 of that income must be in the form of wages, okay? So if somebody was doing something and being paid a wage. First, we reduce the income by the standard deduction, okay? And since they are 65, over 65, we take an additional $2,000 off. So the total, and they're making a contribution to an IRA because they are working and are able to take advantage of that savers credit. So in that situation, their total tax due is zero. Now remember, credits are different than deductions and exemptions in that they reduce the tax bill. So in this case, the savers credit results in a $1,000 tax credit, not a tax deduction, taking the total tax bill for these clients down to zero. And why only zero? Because the credit is non-refundable. Okay. So let's move on a little bit here and look at the tax map, okay? And the tax map showed no tax up to $27,800. This was the impact of the new standard deduction plus the additional deduction for being over the age of 65. But let's talk now about the real tax system, okay? If that was all there was to the tax system, what we just went through, that example, it would be relatively intuitive. But unfortunately, that's not the case. In retirement, we see several complicating factors. Each of these factors you see on the screen creates an environment where you can expect to pay what you expect to pay, and what you actually pay may be different. Let's dig into each one of these. Let's talk first of all about RMDs. So how do RMDs work? RMDs, required minimum distribution. Very simply, they apply when you reach age 72. That was something that was changed in the change of the law in 2017. And it was enacted, I believe it was enacted for the tax year of 2020, that you do not need to take a distribution until you reach age 72. Okay. Now, I am not a fan of the way the government and tax law has made these trickier to understand, like age 59 and a half for distributions, age 70 and a half for a required minimum distribution. I don't like that at all because it's a little bit confusing to know, well, so when were you 70 and a half? Therefore, when do you need to take your distribution? It's now very simple. If you haven't been subjected to RMDs yet, the year in which you reach age 72 is the year that you must take a deduction. Okay. Now that means if your birthday is on December 31st, 2021, that's when you're going to turn 72, you will be taking our required minimum distribution for the year. So good idea to not wait until December 31st to address that, because you'll probably miss the deadline and get to pay a penalty for that. But how an RMD is calculated is to divide the prior year's ending account balance by your remaining life expectancy. And there's a government table for the life expectancy. It's not arbitrary. So what if you have multiple deferred accounts? What if you have a 401k and you also have a 403b and you also had a 457? All of those are combined to determine what your total required minimum distribution will be. Now, there's some tricks to that. So if you have that kind of situation, I'm glad to address that in an individual call. But it is very important that all of your deferred accounts be considered when you reach age 72. Sometimes people think that if they have not rolled their 401k into an IRA, that they are not yet subject to these rules, and that simply isn't true. It can get you in quite a bit of trouble, as a matter of fact, because the penalty for not taking a required minimum distribution is 50%, 50. So if you should have taken a distribution of $50,000 based on your account balance and your age, and you did not take it, then the penalty for that is $25,000 plus that $50,000 is added to your income for tax purposes. So it's greater than a 50% penalty. Obviously, this is not something that we want to have happen. So we really want to be able to pay attention to that. So let's go into a little more detail, though, as to how they work. So this is what's called the uniform lifetime life expectancy. Okay, this is actually kind of works in our favor, I guess you might say, but doesn't matter whether it does or not. This is what we have to live by. Okay, notice that each year that you age, your life expectancy goes down by less than 1 year. So that the table runs all the way out to age 115. And even at 115, you only have to take out a little more than half of the prior year's ending balance. So this is actually something that had a little bit more forethought, I think, when it was being calculated. Back when the required minimum distributions, by the way, sometimes people ask, when did this all come about? And it really is part and parcel to the 401k movement, which was connected to all of the other deferrals that begin with 4. Okay, so it looks as though this is really no big deal. Okay, all right, I understand what that is, but there's a key factor. Okay. If you've done a good job of saving into your IRA or whatever it was before it became an IRA when you converted it, your minimum distribution plus your Social Security might be more money than you actually need to maintain the lifestyle that you choose. So if that's the case, it's likely that you will be paying more in taxes on the back end than you could be. And we'll talk about that in a few slides. Okay, so now let's talk about another subject in taxation, and that is capital gains. So capital gains have some parts of capital gains are easy to understand and deal with, some not so much. Mostly when we think about it, you think that only the 15% tax because my income is lower than $500,000. And so I only have to pay that tax when I sell something that has depreciated. But that isn't necessarily true. What many people don't realize is that you can recognize capital gains even without selling anything if you own mutual funds. That's called a phantom gain. Okay, now let me illustrate this with an example. Say mutual fund A bought Apple stock in 1985. You bought this mutual fund that owns this Apple stock in 2019, and you held it all the way through 2021. In the middle of 2021, the fund manager decides that Apple isn't a good investment value anymore and sells the entire position. Any gain that was recognized on the sale must be passed through the mutual fund to the current shareholders, even if they didn't participate in any of the gain of the underlying stock. Now, we're making a big assumption about Apple here and saying that we're assuming here that Apple's on the decline, and that's why the fund manager decided to sell it. I think we use Apple just simply because it's a popular stock and people understand what it is. But I don't want you to miss what the reality is here. If that mutual fund manager sells a large position in Apple, you may not have ever recognized any gain, but you will be taxed on the gain that was realized and your proportionate share as to how much of that fund you own. So that's an important thing to look at. And in 2008, 2009, when the market took such a big hit, many people were negatively affected by this, very negatively affected. And it wasn't pleasant. So it's something to be looked at when you're looking at your investment portfolio. Okay. Well, the important thing to remember about capital gains is that if you have invested non-qualified money, even if you're generally a buy and hold type of investor, it's likely that you will recognize at least some capital gains in some years. So, and more importantly, when you experience a capital gain on your return, it can have a greater impact than just the gain, the tax on the gain, because it also increases your adjusted gross income and may cause other deductions and exclusions to be phased out. This is important stuff to be paying attention to. And remember, I started by saying, my friend Dan Slott says, not all money is taxed in the same way. Well, let's move on to something else that comes up frequently, and that is Social Security. How is Social Security taxed? Social Security is taxed based on your other income. If all you had on your tax return was Social Security, you would pay no federal income tax at all. But when you have other types of income, it can cause your Social Security to become taxable. So it's common among advisors to say 85% of your Social Security benefits are going to be taxable. Well, I don't like to generalize that way because that can be dealt with. For high income people, 85% is often the taxable amount and 15% of the benefit is tax-free. For middle and upper income folks, that's often not true because it's based on a formula called provisional income, and that can have some strange impacts. So we're going to walk through how that happens. Okay. Your provisional income includes 1/2 of your Social Security benefit plus all other taxable income, including dividends and realized capital gains, interest, plus non-taxable interest earnings, such as from municipal bonds. Okay. Once we've calculated the provisional income, okay, then we need to look at what's the threshold for taxation of Social Security. Again, 50% of Social Security, all ordinary income. Ordinary income, by the way, would be distributions from a retirement plan, a 401k, an IRA, anything in that category, dividends and capital gains and non-taxable interests. Well, the benefit tax thresholds are as shown here. If your provisional income is less than $25,000 and you 25,000 or less, and you're a single person, then 50% of your Social Security benefit will be taxable. If your provisional income is above $34,000, then 85% of your Social Security benefit will be taxable. Once we've calculated these for a married couple, we see that 50% of their Social Security benefit is taxable if their provisional income is $32,000 or less. And if it's at $44,000, then 85% of their Social Security benefit is taxable. Some of you may have heard about zero is our hero and the power of zero. And these are concepts that we look at with our clients. Most advisors should be looking at these to see, is there anything that we can do to reduce the amount of income that is taxed? So it's a very important consideration. And if we can get people's Social Security to not be taxable, we really feel as though zero has been the hero. Well, let's look at some tax examples, because I think it's easier to understand when we're really looking at some real numbers here. Here we've got a couple, okay, that has $20,000 worth of Social Security income and a $40,000 withdrawal from an IRA. We take half of the Social Security and add that to the IRA withdrawals, and we come up with $50,000 of provisional income. Then we apply the first threshold. For a married couple, that's $32,000. So we're $18,000 over that threshold, and 50 cents of each dollar over the threshold becomes taxable. So we have $9,000 of taxable Social Security there. Now we apply the second threshold, which is $44,000. We're $6,000 over that threshold, and so 85 cents of every dollar over that threshold becomes taxable. So that creates an additional $2,100 of taxable income. We already picked up the first 50 cents of each dollar in step one, which is why we only multiply by 0.35 here. In other words, though we have $60,000 of household income, only 55% of the Social Security benefit is taxable. Now let's take another example. We still have $60,000 in household income, but in this one, we have $40,000 worth of Social Security and $20,000 of an IRA withdrawal. We take half of the Social Security and add it to the IRA withdrawal to get a provisional income of $40,000. We're $8,000 over the first threshold, so that creates our $4,000 of taxable income, but we're still under the second threshold. So of $40,000 of Social Security income, $36,000 is tax-free, and only 10% of the Social Security benefit is taxable. Okay. Now, I have to remember to look over here and see if I'm being asked any questions. It doesn't look as though I am, so we'll keep moving along. Okay, now let's look at this on the return. When we bring these numbers onto the tax return, we'll see it a bit more clearly. The 401k or IRA $40,000 of the IRA, okay, $20,000 of the Social Security blend results in $2,000 $398 in federal income tax. I mean, I got it. There's a taxable Social Security, other taxable income. So the total taxable income is $51,000. We take the standard deduction and the personal exemption being over age 65. So the net taxable income is $23,200. And that gives us a total federal income tax bill of $2,398. Let's look at this with $20,000 taken from the IRA and $40,000 of Social Security. Okay, so again, we've got tax on the Social Security of $4,000, other taxable income $20,000, but we have $24,000 in total taxable income minus the standard deduction and personal exemption of $27,800. We have no taxes paid here. I want to pause here for a moment because I know that most of the people who are on the call are saying, how do I do that? How am I going to only take $20,000 from my IRA, especially when I have required minimum distributions? And that's where the work comes in to say, is there anything that can be done to pay taxes now rather than paying taxes later in order to be able to take a lesser taxable withdrawal? We always want to be sure that we're withdrawing in the most tax efficient way possible. Now, I want to be perfectly clear here. We are not talking about not paying taxes. We're talking about when we should pay taxes. What is the most efficient way to pay taxes and to position our money so that our tax bite is minimized? Okay. Now, there are some other things that need to be considered when we're talking about income. And one of those in particular is Medicare's excess premium. That excess premium is called IRMA, I-R-M-A-A. And IRMA is not necessarily a gal you want to be hanging out with, but you probably will be, at least for some part of your retirement. Let's look at married filing jointly in 2021. Okay, the numbers we're showing here are per person. Okay, so the Part B annual premium, okay, if your household income for a couple is less than $176,000, your Part B premium is $1,782. Okay, so that is the standard cost for Medicare. Part D is the plan cost only. There is whatever Part D stands for drugs, by the way. I know Tom is listening to this and he's our Medicare specialist and he doesn't use the same terminology, but I'm talking about understanding it in the best way possible. So remember, D is for drugs. Okay, you buy a prescription plan from an insurance company, but it is regulated through CMS, the Center for Medicare Services. So if your income is less than $176,000 for a couple, you will only pay the actual cost of that. You will not pay an IRMA premium. If your income is between $176,000 and $222,000, your Part B premium, you can see, is going to be higher by about $700. And by the way, this information will be on the tax chart that AFIA has provided for us. So, and then on an annual basis, if your income is in that category between 176 and 222, you're going to pay the cost of the plan plus $147. Seems like more when I say 1,000. I'm going to skip through some of these, but I just want to move to the second from the last here, because I know that between pensions and deferred accounts and so forth, when we get the RMDs, many of our clients will be in the situation of having income between $330,000 and $750,000 per year. If that's the case, they are going to pay an additional $5,702 for their Medicare Part B and an additional $848 for Part D, the drug coverage. Again, these are being pointed out to you so that you understand that anything that you can do to reduce these premiums, because these are based on today's premiums, the percentages of increases will increase as Medicare premium increase over time, and certainly they will. So it really is meant to emphasize how important it is to be paying attention to how much of your income is taxable. Let's talk about the net investment income tax. This is a question that we get quite frequently, and I think this is the simplest explanation I have ever seen. If you have adjusted gross income over $200,000 as an individual, a single filer, or $250,000 as a married couple, then you will be subject to the net investment income tax on capital gains and dividends, interest and annuity payments, passive business income, and rents. Sometimes people think that passive business income and rents have a better overall taxation, and that may be the case. I'm not going to jump to a conclusion on that, but the 3.8% net investment income tax affects those sources of income. Okay, so we used to have a personal exemption, a PEP, and we had a PEP phase out that reduced your personal exemption by 2% for each $2,500 over the thresholds. And then there was the Pease limitation that was named after Don Pease, who was a congressman from Ohio way back when I was living in Ohio. And this reduced itemized deductions by 3% of the adjusted gross income, blah, blah, blah. And I'm saying blah, 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 because it was so confusing that it was eliminated in the Tax Act in 2017. The standard deduction replaced those phase outs. Okay, the alternative minimum tax, okay. So it's conceptually simple. A flat tax of 26 to 28% of income over a relatively high threshold, which was further increased by the Act. But the difficulty in this is in the calculation. You have to start with your 1040 AGI, which is adjusted gross income, and then work backwards, adding back in deductions and adjusting for transactions that are treated differently for AMT than for regular income tax. The good news about this is 0.1% of taxpayers were impacted by the AMT in 2019. And that includes 0.2% of households with incomes between 200,000 and 500,000. So I think that in areas where we can actually focus and make a difference is really where we should be focused, because this is not as effective or does not affect as many people. All right, so let's now talk about effective marginal tax rates. If you get your tax return and it has the first page, sometimes has a comparison. This is what you paid in 2019. This is what you paid in 2020, and it gives the difference. Most tax preparers include this. I think it's part of all of their preparation software these days. And then down at the bottom, it says your marginal rate and your effective rate. Okay, pretty confusing stuff. So the complications that we talked about back here, prior to this, all the other subjects we just covered, should highlight one major point, and that is over time, when the government has needed new tax revenue, the method has not been to change the rates on brackets evenly across all taxpayers. Instead, it's been to introduce phase-outs of deductions or exemptions, to begin to include income that was previously not taxable, like Social Security benefits. The result of this, of course, is that the tax system, which is the most important number, is not necessarily the tax bracket you're in, but instead is your effective marginal rate. Now, one of the reasons why I think that this conversation that we're having today is so important is because the impact of COVID, we don't yet really know what that income or what that impact is going to be. And I'm not talking about the sickness, the loss of life, and those personal tragedies. I'm talking about another unknown factor that we'll all have to deal with, and that is what is going to happen with taxes in the future. Okay, so it's really important that we get a good handle on this so that we are really clear on everything that we can do to improve our marginal tax rates. There is proposed it's not, I don't, that's probably not the right word to use. The Biden administration has said that they will address taxes and will adjust tax rates. I don't know anyone who really believes that after all that we've been through and all the debt that our country has accumulated, not just this past year, but added on to other debt, it's unlikely to think that tax rates are going to go down in the future. We can't control those. Oh, yes, we can control at the ballot box by voting for people who we think are going to uphold our wishes and values with regard to taxes. But it's unlikely that we can affect a change there as well as we can affect a change in our own personal circumstance by doing everything that we can to control what parts of our income are subject to tax. So let's look here now at the tax map again. Remember, as you increase ordinary income from the left to the right across the bottom, you can see the rate that should intuitively be applied to the next dollar. Okay. Now here's the tax map for the capital gains. Okay. Now let's get real about this, as we did back a few slides ago, and talk about a real situation. John and Jane are married, filing jointly. They are over the age of 65. They have $61,000 in combined Social Security income. They have $10,000 of net long-term capital gains. And they have a $52,000 required minimum distribution on deferred accounts that they have. Okay. Here's their tax map. You can see that once they harvest a little over $10,000 in ordinary income, they begin to experience an 18.6% effective marginal tax rate. That's the point in which their ordinary income plus their capital gains drags enough of their Social Security into the calculation to begin making every additional dollar withdrawn from the IRA taxable at 10%. And each additional dollar over that drags another 85 cents of Social Security into the mix, which creates an effective marginal rate of 18.6%. You can see this couple never really experiences the 10 or the 12% bracket. They go from 18.6 to 22.2 to almost 50% before dropping back down into the regular bracket. Whoa, wait a minute. almost 50%. The 49.95, how did that happen? This example is one of my favorites to bring up, and I'm using the wrong word, favorite. I like to bring this up because this happens so frequently. Okay, let's say they're intuitively, they're in a 12% bracket for ordinary income. So you would expect an additional $1,000 withdrawn from their account to create 12% of tax, or $120. But here's what actually happened. That additional IRA withdrawal in the 12% bracket at $120 causes $850 of taxable Social Security in the 12% bracket, which is another $102, which causes $1,850 of capital gains to be taxable in the 15% bracket at $277.50. So the total tax burden on that $1,000 of withdrawals is $499.50. Now, I will admit to you that this gets buried in the details, okay? That in the overall signing of the tax return, the focus is not on the fact that that $1,000 created nearly $500 in taxes. But I think it's important that we acknowledge that. And one of the things that I have had happen that people have mentioned is, and I'm a grandmother, so I feel as though I'm not unfairly picking on grandmothers. Grandma decided she wanted to get a couple of gifts for the grandkids, and she has money in her IRA, and it's not needed to meet the family's monthly expenses. So she takes a withdrawal from her IRA of $1,000, and in effect, this is the result. Okay, that's a crazy example, but it's absolutely the truth. Okay, so the real tax system of capital gains, okay, let's talk about that. You have a very similar effect with that. If the couple were choosing whether or not to sell a stock with a $25,000 gain this year, they would certainly want to know that on a portion of that sale, they would actually lose part of that sale to federal income tax. So it may make sense to sell part of the position this year and avoid the spike. We had that conversation with our clients near the end of the year, or the last quarter of the year, every year, so that we are taking income in the right time. I just finished correspondence with a client who wanted to take a $36,000 withdrawal from an account. She's turning on lifetime income of $36,000 a year. And the conversation took place on the 4th of December. And my question to her was, Mary, do you need to have that money before the first of the year? And she said, no, I just want to be helping with my grandson's tuition. Well, let's then not take it all in this tax year. Let's pay attention. And when we went through the calculation, it was very significant, the difference between taking it in 2020 or rolling it over to 2021 because of some other income events that had occurred. And this is what we call tax planning. Okay, tax planning is important. It is different than tax preparation. And we feel as though tax planning is an essential part of your financial planning, because creating a situation where you have, I'll just be generous here and say you can have $200,000 worth of income. Well, is that $200,000 worth of income going to be taxed at a 40% rate? If that's the case, then maybe we want to see how we could impact the taxes in a more effective way. So let's talk about some of the tools that we can use for tax control. First of all, now, If you're retired, some of these things you can't do, but some of these things you absolutely can do. Okay. And one of them is to diversify among account types. Now, we're not talking about accumulation here. We're talking about distribution. Remember several slides back when we talked about the income for the couple that needed $60,000. We realized that by taking $20,000 of taxable income and the 50% of their Social Security, we, in the taxation category, taking the 50% into taxable category, we reduced their tax bill significantly. So looking at where is this income coming from and how is it going to be taxed is important. So we may want to take some money from the IRAs. I know that there are people who have joined our call today who we've been working with, and we're looking at, is this money going to be taxable or not? Well, let's take some taxable income and let's do some Roth conversion, and let's do what we can to manage the taxation, not for 2021, but for 2021 through 2041 or beyond, depending on age and what we're looking at. Let's take a long range view. And remember, when your tax is prepared, when you're dealing with whoever it is that's preparing your taxes, they're dealing with what has happened and how that's going to be handled. Ed Slott has another comment that he makes, and that is talking to your accountant about your taxes for the prior year is sort of like having a death certificate signed in, I can't remember how he says it. Basically, you can't, once the death certificate's signed, it's signed. You're dead. Okay? And what he's saying, what's done is done in income. Very, very seldom can you do anything that is going to provide you with any kind of relief for the prior year. But we want to use all of the tools that are available. We want to use tax-deferred products where appropriate. I have conversations with my clients all the time about the amount of money that they're deferring. Don't just focus on this year's tax. Let's focus on what that deferral is doing. As your 401k balance climbs up, so does your future tax liability. And we want to properly blend these withdrawals from the different accounts. That's what the example that I was just going through. So we also want to consider which assets should be held in which account type. Okay. Now that's kind of an interesting, let me go back here a moment. Which assets should be held in which account type? Okay. So if you think that the stock that you've picked, and we have a client that none of you know, who has invested in Tesla, and he feels as though he probably has a lot more knowledge about the technology behind Tesla than most of us do. The decision as to where that investment should happen, should that investment happen in his 401k, where he did have the ability to purchase individual stocks? Should he purchase something that he thinks is going to have enormous growth, or should he in fact use after-tax dollars to make that purchase? Again, very important when we're looking at assets, and also when we're doing Roth conversion. And Roth conversion is the most effective tax planning that we can do for our clients once they've reached retirement age. Okay, we're going to determine, what should we convert? Should we convert this group of stocks, or should we convert this low growth investment? What we generally find is, let's leave the low growth in the taxable arena, and let's take that we expect to have a higher return. Let's take that out of the taxable arena. Okay, so the conclusion is, of course, that your personal tax map varies greatly based on your personal circumstances. So you had the opportunity to have a call with me. And at that point in time, what we'll do is we'll have a conversation about your individual situation and what your tax map might look like. We'll produce a tax map that can show you where your opportunities for planning might lie. You may have seen this before. It's I love the fact that this judge's name was Learned Hand, but he said anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury. There is not even a patriotic duty to increase one's taxes. Well, I know we all have been financially and emotionally affected by this past year, and as it moves forward into the future. But I think what we want to be certain of is that we are doing everything we can in our taxation and in our investments to provide best that we can for ourselves throughout our lifetime. All right, so Afia is on all social media, and I think that that's not something that I participate in. I know what they are, but that's not where I get my information. So let's move on to say that Afia has provided this information, but as the instructor, I'm very happy to answer any questions that you might have. You will receive the survey form, the evaluation form. We would like very much for you to complete that. That will give us your email address, and we'll distribute the tax chart to you, and I want to give you a look at that. Okay, I want to share an additional, hang on for just 1 minute while I grab that, and I'm going to share that. Okay, I realize that this looks like the world's tiniest print. It's not really that way when you receive it, but it's a full-size sheet that gives you all of the information about federal income tax, head of household, standard deductions, filing status. On the second sheet, it talks about IRA contributions. It does here talk about the Social Security benefit and taxation thereof, required minimum distributions. It's a really, really great informational piece. And again, if you receive this and there is revision to it later in the year, if there is change in our tax regulation, we'll be sure to update you. So at this point in time, I would ask Kelly, do we have any questions to be addressed?
Hi, Nan. I've been answering a couple as we've gone. There was a question about RMDs for Roth IRAs.
Yes. Okay. So RMDs for Roth IRAs. Okay. There are regulations for distribution of Roth IRAs, but they are not subject to RMDs. The regulations around Roth are just simply that you have to have had your Roth account for a minimum of 5 years in order to be able to enjoy all the tax-free benefits. Okay, so so the straight answer to the question is Roth IRAs are not subject to RMDs as long as things have been done properly, and we can verify that for you.
The other question was, do we have until April 15, 2021 to do a Roth for 2020?
No, we do not. We can make contributions, but we can't do the conversion. The conversion happens in the tax year. So a conversion that we do now will be taxed in 2021. We could, if we had an existing Roth and we had some money that we wanted to put in Roth and we had, we met all of the qualifications, we could in fact make that contribution up until April the 15th. Look forward to talking to any of you who desire to do so. And I think Kelly has given that information on scheduling a time on Calendly, or you can call our office and get that scheduled. And those of you who are in California, you can call our regular Monterey number that forwards to our number here.